Before we begin, it's crucial to state that this presentation is for informational and educational purposes only. I am not a licensed financial advisor, mortgage broker, or real estate agent. The information provided in this video is not intended as financial, legal, or investment advice. Buying a home is one of the biggest financial decisions you will ever make, and you should always consult with qualified professionals, like a certified financial planner and a licensed mortgage loan originator, to discuss your specific situation before making any decisions. All examples are hypothetical and used for illustrative purposes. The biggest lie in American real estate is that you need 20% down to buy a house. The second biggest lie is that you need any money down at all. For generations, we've been told to save and scrimp for years, stuffing money into a savings account, just to come up with a massive pile of cash for a down payment. It's presented as the only way, the responsible way, to achieve the American dream of homeownership. But what if that dream isn't locked behind a 5-figure paywall? What if the key to your own front door costs you little to nothing out of pocket? Today we are going to dismantle that myth piece by piece. We're going to expose the truth about buying a home in the United States with a zero down payment mortgage. This isn't a fantasy. This isn't a clickbait scam. These are real, legitimate, and powerful loan programs that are used by thousands of Americans every single month to go from renting an apartment on Tuesday to owning a home on Friday, without draining their life savings. If you've ever felt that soul-crushing anxiety of watching home prices go up while your savings account stays flat, if you've done the math and realized it would take you 7, 10, maybe 15 years to save up a traditional down payment, if you're tired of paying your landlord's mortgage instead of building your own equity, then this is the most important video you will watch this year. I'm going to show you exactly how these programs work, who qualifies for them, what the pros are, and just as importantly, what the hidden risks and catches are. No fluff, no sales pitch. Just the unfiltered truth you need to know. Now, I can hear the skepticism already. Zero down? Sounds too good to be true. What's the catch? And you are 100% right to be skeptical. In the world of finance, there's no such thing as a free lunch. And while these loans can be an incredible opportunity, they come with their own unique set of rules, costs, and potential downsides. We will cover all of it. We'll talk about mortgage insurance, higher interest rates, and the risk of being underwater on your loan. My goal isn't to sell you on a zero-down mortgage. My goal is to arm you with the knowledge to decide if it's the right weapon for your financial journey. But first, to understand why these programs are so revolutionary, we have to understand the monster they were created to fight. The myth of the 20% down payment. Where did this idea even come from? It feels like it's been around forever, a sacred rule of finance. But it hasn't. The 20% rule is actually a relic of a bygone era. Before the Great Depression, buying a home was a completely different game. Mortgages were often short-term, sometimes only 5 or 10 years, and they required massive down payments, frequently 50% of the home's value. At the end of the term, you had to pay the entire remaining balance in one giant balloon payment. As you can imagine, this system was incredibly unstable and only the wealthy could afford to participate. When the economy collapsed in the 1930s, this system shattered. Millions of Americans defaulted. To stabilize the housing market and make homeownership accessible to the middle class, the U.S. government stepped in and created institutions like the Federal Housing Administration, or the FHA. They introduced the 30-year fixed-rate mortgage we know today, which completely changed the landscape. So where does the 20% figure come in? It comes from the invention of something called private mortgage insurance, or PMI. Lenders are terrified of risk. If you borrow money to buy a house and you stop paying, they have to go through the expensive process of foreclosure. The down payment is your skin in the game. It's a cushion for the lender. If you put down 20%, the lender feels secure that even if they have to foreclose and sell the house, they won't lose money. If you put down less than 20%, they see you as a higher risk. So, they require you to pay for an insurance policy, PMI, that protects them in case you default. The 20% mark became the magic number to avoid paying that extra monthly fee. Somehow, over the decades, the way to avoid PMI morphed into the only way to buy a house. It became a cultural belief, passed down from parents to children, echoed by financial gurus and real estate agents. It became a gatekeeping mechanism, whether intentional or not, that kept millions of perfectly qualified, credit-worthy people trapped in the cycle of renting. People who could easily afford the monthly mortgage payment, but who simply couldn't save $60,000 or $80,000 for a down payment in today's market. That is the world we live in now. A world where the old rules no longer apply. The financial landscape has shifted, and powerful new tools have been created to bypass this outdated obstacle. These tools are the zero-down and low-down payment mortgages, and they fall into two main categories: government-backed loans and a few conventional and private options. The government-backed programs are the titans of the industry, the most widely used and accessible options for buying a home with nothing down. There are two undisputed kings in the zero-down world. The first is a benefit, an honor earned through service to our country, designed for veterans and active duty service members. The second is a program designed to build up and populate rural communities across America. Both of these programs allow you to finance 100% of the home's purchase price. That's not a typo. 100%. So let's start with the most powerful mortgage product in the United States, a loan so beneficial it's considered one of the greatest perks of military service. A thank you written into federal law for those who have worn the uniform of our nation. Let's break down the VA loan. It's a benefit earned in the dust of basic training, in the quiet discipline of a duty station, and for many, in the crucible of deployment. The VA loan isn't a handout. It's a hand-up, engineered by the federal government to solve the biggest problem facing homebuyers: the down payment. So how does it work? How can a bank possibly give you a loan for hundreds of thousands of dollars with absolutely nothing down? The secret lies in a single word: guarantee. The U.S. Department of Veterans Affairs doesn't actually lend you the money. You still go to a private bank, a credit union, or a mortgage lender just like anyone else. But here's the game changer. The VA steps in and provides the lender with a guarantee on a portion of the loan. Think of the VA as the ultimate co-signer. They are essentially telling the bank, listen, this veteran has served our country. They are a good risk. But if for some reason the absolute worst happens and they can't pay their mortgage, we've got your back. We will cover a significant portion of your loss. This guarantee is like an insurance policy for the lender, and it fundamentally changes their risk calculation. For a typical loan, the bank's biggest fear is that if you default early on, they'll sell the house at a loss. Your down payment is their cushion against that loss. But with the VA's guarantee, that risk is dramatically reduced. The bank's cushion is now provided by the U.S. government, and because their risk is so low, they are willing to do something extraordinary. Lend up to 100% of the home's value. That means zero down payment. Let's put that into perspective. The median home price in the United States is hovering around $400,000. For a conventional loan, you might need 5% down, which is $20,000. If you want to avoid extra insurance, you need 20% down, which is a staggering $80,000. That's $80,000 in cash you need to have saved up just to get the keys. For most people, especially young service members or veterans just starting their civilian careers, that's an almost insurmountable mountain to climb. The VA loan levels that mountain. It means you can go from renter to homeowner based on your income and credit, not on how much cash you've managed to stash away. But the zero down payment feature is only half of the magic. The other half is the elimination of something called PMI, or private mortgage insurance. If you get a conventional loan and put down less than 20%, the lender will force you to pay for PMI. This is an extra insurance policy that you pay for, but it protects only the lender, not you. It's a fee for being a high-risk borrower. On that same $400,000 home, PMI could easily add $200, $300, or even $400 to your monthly mortgage payment. That's money that completely vanishes. It doesn't pay down your loan. It doesn't build your equity. It's just gone. With the VA loan, because the government is already providing that guarantee, there is no need for PMI. Ever. It doesn't matter if you put 0 down or 10% down. There is simply no monthly mortgage insurance. This single feature can save you tens of thousands of dollars over the life of your loan and makes your monthly payment significantly more affordable. So, who is eligible for this incredible benefit? This is a question that stops a lot of people who might otherwise qualify. The eligibility rules are surprisingly broad. Generally, you're likely eligible if you fall into one of these categories. You've served 90 consecutive days of active service during wartime, or 181 days during peacetime. If you're a veteran who served after the early 1980s, the requirement is typically 24 continuous months of service. For members of the National Guard or Reserves, it's usually after 6 years of credible service. And importantly, this benefit also extends in many cases to the surviving spouses of service members who died in the line of duty or as a result of a service-related disability. The key to unlocking this benefit is a document called the Certificate of Eligibility, or COE. This is the official proof from the VA that you meet the minimum service requirements. Don't let this document intimidate you. In most cases, your mortgage lender can get it for you online in a matter of minutes. Now you might be thinking this sounds too good to be true. A government program this good must have a catch. And there is one, but it's a reasonable one. It's called the VA funding fee. This is a one-time fee paid to the VA to help keep the program running for future generations of service members with no burden on taxpayers. The fee is a percentage of the loan amount and varies based on your service, your down payment amount, and whether it's your first time using the benefit. For a first-time user with zero down, it's typically 2.3% of the loan. But here's the crucial part. You don't have to pay this fee out of pocket. In nearly all cases, it can be rolled right into your total loan amount and paid off over the life of the mortgage. And even better, there are major exemptions. The most common one is for any veteran receiving VA disability compensation. If you are, the funding fee is completely waived. Gone. Over the years, a lot of myths have sprung up around the VA loan, so let's bust a few of the big ones right now. Myth number 1. You can only use it once. This is completely false. You can use your VA loan benefit over and over again. Once you sell the home and pay off the loan, your entitlement is typically restored in full, ready for your next home purchase. Myth number 2. The VA loan has higher interest rates. Again, false. The VA doesn't set interest rates. Private lenders do. And because these loans are so secure for lenders, the interest rates are often some of the most competitive on the market. Myth number 3. The process is slow and full of red tape. Decades ago, this might have had a sliver of truth. Today it's a myth. With a lender who is experienced in VA loans, the process is streamlined and often just as fast as a conventional loan. The key is finding a lender who understands the program. Imagine a 27-year-old Army captain who just finished her service. She's starting a new job in a new city. She has a good income and excellent credit, but she spent the last 5 years moving from base to base, and her savings account isn't ready for a 20% down payment on a home. Her friends are all telling her she'll have to rent for at least 3 or 4 more years to save up. Then she talks to a lender who tells her about the VA loan. She discovers that she can buy a home right now. She finds a perfect $300,000 townhouse. With $0 down, her loan covers the full purchase price. She rolls the funding fee into the loan. She pays no monthly PMI, saving her over $200 a month compared to her friend who bought a similar house with an FHA loan. In 30 days, she moves into her own home, building equity and starting her new life, all because of a benefit she earned serving her country. That is the power of the VA loan. It's not just a mortgage product, it's a pathway to stability, to wealth creation, and to planting roots in the country you swore an oath to defend. It is, without a doubt, one of the most substantial financial benefits available to any group of people in the United States. But what if you haven't served in the military? Is the dream of a zero-down home completely out of reach? Not at all. There's another powerful government-backed program, designed not for soldiers, but for pioneers. A program for people willing to put down roots not in the bustling suburbs, but in the heartland of America. A program that could let you buy a home for literally $0 down, in thousands of communities you've probably never even considered. It's a program from an agency you'd never expect to be in the mortgage business. The United States Department of Agriculture, the USDA. Now hold on. Before you click away thinking, I'm not a farmer, I don't want to live on a farm, you need to understand one critical thing. The USDA's definition of rural is probably not what you think it is. At all. This isn't about buying 100 acres in a silo. This is about revitalizing the backbone of the country, the small towns and communities that sit just outside the major metropolitan sprawl. In fact, a staggering 97% of the landmass in the United States is located in a USDA-eligible area. Think about that. Almost the entire country. This program is officially called the USDA Rural Development Guaranteed Housing Loan Program. That's a mouthful, so let's just call it the USDA loan. And its primary mission is to help lower to moderate income households buy homes in these designated rural areas. The government isn't the one lending you the money directly. Instead, they act like the ultimate co-signer. They provide a guarantee to private lenders, banks, credit unions, saying, hey, if you give this qualified person a mortgage with zero down payment, we've got your back. We'll cover a huge portion of the loss if they default. This guarantee removes the risk for the lender, and in turn the lender removes the biggest barrier for you, the down payment. That's the magic. It's a government-backed promise that unlocks the door to a 100% financed home loan. So, the first and most incredible benefit is, of course, no down payment. Not 3%, not 5%. 0. You can literally move into a home without saving up tens of thousands of dollars for a decade. But the benefits don't stop there. Because the loan is government guaranteed, the interest rates are often some of the most competitive on the market. Frequently, they are lower than conventional loans, which saves you thousands or even tens of thousands of dollars over the life of the loan. And here's another huge financial advantage. Remember how with FHA loans and most conventional loans with less than 20% down, you have to pay private mortgage insurance or PMI. That extra monthly fee that protects the lender, not you? USDA loans have something similar, but it's structured much more favorably. They have an upfront guarantee fee and an annual fee. Now that might sound bad, but here's the key. The upfront fee can be rolled right into the total loan amount. You don't have to pay it out of pocket. And the annual fee, which is paid monthly, is typically much lower than the PMI on an FHA or conventional loan. So your monthly payment is often significantly less. 0 down, a lower interest rate, and a lower monthly insurance fee. Sounds almost too good to be true. So what's the catch? There are always catches, right? Well, with the USDA loan, they're not so much catches as they are very specific requirements. And there are two big ones you have to clear. The first and most obvious is location. The property you want to buy must be in a USDA-eligible area. This is non-negotiable. But here's the secret that most people miss. Rural is defined by population density, not by cornfields. The USDA has an official eligibility map on their website. You can type in an address and it will tell you instantly if it qualifies. You would be absolutely shocked to see the areas that are eligible. We're talking about small towns with charming main streets, communities with populations of 10,000, 20,000, even up to 35,000 people. Many of these places are just a 30 or 45-minute drive from a major city center. They have good schools, local shops, parks, and a real sense of community. They are the kinds of places that feel like suburbs, but are technically, for the purposes of this loan, rural. So the first step for anyone even considering this is to go to that map. Play with it. Look at the areas just outside the major city you're currently priced out of. You might find a hidden gem of a town that qualifies, completely changing your home buying landscape. The second major requirement is income. This program isn't for high earners. It's specifically designed to help low to moderate income families. Every county in the country has its own specific income limit, which is based on the number of people in your household. For example, in one county, the limit for a one-person household might be $110,000 per year, while in a more affordable county, it might be $90,000. And for larger households of 5 or more, that limit increases. The USDA looks at your total household income. That's the income of every adult who will be living in the house, even if they aren't on the loan application. They want to make sure the people using this program are the ones it was designed to help. So you can't make too much money. But you also have to make enough money to comfortably afford the monthly mortgage payment. The lender will still look at your debt-to-income ratio to make sure the new house payment won't stretch you too thin. So we have location and income. What about credit? This is where it gets even more accessible. While there's no official minimum credit score set by the USDA itself, most lenders that offer these loans look for a score of around 640. That is significantly more forgiving than what's often required for the best rates on a conventional loan. A 640 score is very achievable for the average American. And even if your score is a little below that, there's still hope. Lenders can sometimes approve the loan through a process called manual underwriting, where they take a closer look at your entire financial picture, like a strong history of paying rent on time or having significant savings, to offset the lower score. Let's put this all together. Imagine a young couple. Let's call them Sarah and Tom. They live and work in a big city. They have decent jobs, maybe a teacher and a graphic designer, making a combined income of $95,000 a year. They've been trying to save for a down payment, but with high rent and student loans, it feels impossible. The median home price in their city is $500,000. A 3.5% FHA down payment is $17,500 plus closing costs. Feels like a mountain they'll never climb. They feel stuck, defeated. Then they hear about the USDA loan. They're skeptical. We're not farmers. But they go to the eligibility map online. They zoom out from their city and see the colored shading that indicates eligible areas. And there it is. A town just 40 minutes away by train. It's a place they've driven through before. It has a nice little downtown, a state park nearby, and a great reputation for its schools. They check the property listings and see charming, well-kept 3-bedroom homes for around $325,000. Suddenly, homeownership doesn't seem like a fantasy. Next, they check the income limits for that county. For a 2-person household, the limit is $105,000. Their $95,000 income fits comfortably underneath that. Tom's credit score is 680. Sarah's is 710. They're well above the typical 640 minimum. They make a call to a mortgage lender who specializes in USDA loans. The loan officer confirms it. Based on their income, credit, and the location they've chosen, they are prime candidates for a zero down payment loan. The estimated monthly payment, including taxes, insurance, and the USDA annual fee, is actually less than what they're currently paying in rent for their small city apartment. For them, this program isn't just a mortgage. It's a key that unlocks a future they thought was locked shut. The ability to own their own home, to build equity, to plant a garden, to join a community, all without having to drain their savings account to zero. This is the power of the USDA loan. It's a pathway to the American dream, routed not through the gleaming high-rises, but through the heart of the country. But finding out you're eligible is just the first step on the path. The application process for a USDA loan has its own unique quirks and potential pitfalls. There are specific property requirements the house itself must meet, and a government approval process that can add extra time and paperwork. Getting from pre-approval to finally holding the keys requires a strategy. You need to know exactly what the underwriters are looking for, the common mistakes that can get your application denied at the last minute, and how to assemble a team, a realtor and a lender, who truly understands the ins and outs of this very specific, very powerful loan. So let's pull back the curtain on the most mysterious and misunderstood figure in the entire home buying journey: the underwriter. This isn't just a person at a desk stamping papers. Think of them as the final boss, the gatekeeper standing between you and the keys to your new home. Their job, in the simplest terms, is to protect the bank's investment. They are financial detectives, and your loan application is their case file. They're not looking for reasons to deny you. They're looking for irrefutable proof that you are a safe, reliable person to lend hundreds of thousands of dollars to. They need to build a rock-solid case that, yes, you will pay this loan back on time every time. And to do that, they scrutinize everything. Not just your credit score, but the entire story your finances tell. And this is where so many zero-down mortgage applications fall apart. Right at the finish line. It's almost never one big, obvious thing. It's a death by 1,000 paper cuts, small, seemingly innocent mistakes that, to an underwriter, look like giant flashing red flags. Let's talk about the number one application killer: the mysterious large deposit. Imagine this. 2 months before applying for your loan, your amazing grandmother gives you $5,000 to help with moving expenses. You deposit the cash into your checking account and think nothing of it. Fast forward, you're in underwriting. They're reviewing your last 2 months of bank statements, and suddenly this $5,000 deposit sticks out like a sore thumb. To you, it's a gift. To the underwriter, it's a potential undisclosed loan. Is it a loan from a friend you have to pay back? Did you take a cash advance on a credit card? Is it income you didn't claim? They have no idea, and their job is to assume the worst until proven otherwise. Any undocumented debt could throw your entire debt-to-income ratio out of whack, instantly disqualifying you. This single mistake can send your file into a tailspin, with the underwriter demanding explanations, letters, and proof of the source of funds, delaying your closing or even leading to a flat-out denial. The solution? Simple, but you have to do it up front. Any large, non-payroll deposit needs a paper trail. If it's a gift, you need a formal gift letter signed by the person who gave you the money, stating clearly that the money is a gift and not a loan that needs to be repaid. Document everything. The detective needs to see all the evidence. The second cardinal sin is messing with your credit profile after you've been pre-approved. I need you to hear this. The moment you get that pre-approval letter, your financial life needs to go into a self-imposed lockdown. The lender pre-approved you based on a snapshot of your finances on a specific day. The underwriter's job is to make sure that snapshot is still accurate on the day of closing. I have heard absolute horror stories. A couple gets pre-approved, they find their dream home. Everything is going smoothly. 2 weeks before closing, they get excited and decide to go buy all new furniture for the house. They go to a big box store and open a new store credit card to get 0% financing for 5 years. Seems smart, right? Wrong. that new account hits their credit report. The lender runs a final credit check right before closing, which they always do, and the underwriter sees a new line of credit and a new $5,000 debt. Their debt-to-income ratio is now too high. Loan denied. Closing canceled. Dreams crushed. All because of a new sofa. I repeat, do not open any new credit cards, do not finance a car, do not co-sign a loan for your cousin, don't even apply for a new cell phone plan if it requires a hard credit pull. Just freeze. Wait until the keys are in your hand. Mistake number 3 is the mid-process career change. Stability is the holy grail for an underwriter. They want to see a consistent, reliable, and predictable stream of income. If you have a stable W-2 job when you apply, that's fantastic. But if you decide in the middle of the loan process to quit that job and start your own freelance business, or even switch from a salaried position to a 100% commission-based role, you might as well have just lit your application on fire. To an underwriter, that's not a bold career move. It's a massive, terrifying leap into the unknown. They can no longer reliably predict your future income. Even switching from one W-2 job to another in the same field can cause major hiccups if there's a probationary period or a change in pay structure. If you're contemplating a job change, the best advice is to wait until after you close on the house. If you absolutely cannot wait, you must talk to your loan officer before you make any move. They can tell you exactly how it will impact your application and what documentation you'll need to salvage the deal, if it's even possible. Now, all of these mistakes are preventable, but preventing them requires more than just your own diligence. It requires a team that knows the specific playbook for zero-down loans. And this is where so many first-time buyers go wrong. They think any lender and any realtor will do. That is a catastrophic miscalculation. Let's start with your lender, your loan officer. This person is not just a number cruncher. They are your financial advocate. They are the person who packages your case file and presents it to the underwriter. You don't want a generalist. You need a specialist. You need a loan officer who has a deep and proven track record with the specific loan you're using, whether it's VA or USDA. When you're interviewing lenders, don't just ask about interest rates. Ask them, how many VA loans did you close last year? What are the most common underwriting hurdles you see with USDA loans, and how do you help your clients overcome them? A great loan officer will anticipate the underwriter's questions. They'll see that $5,000 gift from your grandma and tell you to get a gift letter before the file even gets submitted. They'll advise you not to move a single dollar between accounts without talking to them first. They are your guide and your first line of defense. A bad loan officer will just collect your documents, submit them, and hope for the best, leaving you to fend for yourself when the underwriter comes back with a dozen questions. Just as critical is your real estate agent. A realtor's job in a zero-down transaction goes way beyond just unlocking doors. They are your strategist on the ground. A great agent who understands these loans knows that your offer needs to be structured differently. For example, with a zero-down loan, you still have closing costs, things like appraisal fees, title insurance, and attorney fees. These can add up to thousands of dollars. A savvy agent knows how to negotiate for seller concessions, where you ask the seller to contribute a certain percentage of the home's price towards your closing costs. This can be the make-or-break element of a truly zero out-of-pocket deal. They need to know how to write an offer that includes this request without scaring the seller away. They also need to understand the property requirements of these loans. They won't waste your time showing you dilapidated homes that would never pass a VA or USDA appraisal. They become a part of your financial team, working in lockstep with your lender to make sure the house you fall in love with is a house you can actually close on. Your lender and your realtor are the two most important hires you will make. They are your A-team. They're the seasoned lawyers preparing you for your day in court with the underwriter. A great team makes the process feel smooth, transparent, and manageable. A bad team or a team that doesn't specialize in these loans will make it feel like you're navigating a minefield blindfolded. So you've built your case, you've avoided the common mistakes, you've hired your expert legal team. Now it's time to find the target. But not just any house will do. These zero-down loans come with their own set of rules about the property itself. In the next part, we're going on the hunt, uncovering the hidden property requirements that can make or break your deal, and I'll show you exactly how to find eligible homes in your area, sometimes in places you never would have expected. So you've found a house. It's got the perfect kitchen, a backyard for the dog. It's in the right school district. But hold on. Before you even think about making an offer with a zero-down loan, you have to ask the most important question. Is the house itself even eligible? Because with these government-backed programs, the property gets put under a microscope just as much as you do. This is a critical hurdle, a secret gatekeeper that disqualifies countless amazing homes, and most buyers don't even know it exists until it's too late. Let's start with the USDA loan because its primary requirement is the biggest and most misunderstood of all: location, location, location. The U.S. Department of Agriculture is trying to encourage development in less populated areas. So the property must be in a designated rural area. Now, when you hear rural, you're probably picturing a farmhouse surrounded by 100 acres of cornfields. And while that would qualify, the USDA's definition of rural is incredibly broad and will shock you. It includes thousands of small towns, suburbs, and even areas just outside major city limits. We're talking about beautiful suburban neighborhoods with manicured lawns and community pools that are, according to the USDA, rural. There are entire counties just a 30-minute drive from major metropolitan hubs that are almost entirely eligible. This is the first major secret. You don't have to move to the middle of nowhere to use a USDA loan. But you can't guess. You have to know for sure. And thankfully, there's a tool for that. The USDA has an official property eligibility map online. You can literally type in any address in the United States, click a button, and it will tell you instantly if it's in an eligible zone. This tool isn't just for checking a house you've already found. It's for hunting. Go to the map, zoom in on the region you want to live in, and look at the areas that are shaded as ineligible. You'll see the major city centers blocked out. But then look at the edges. Look at the towns just outside that shaded zone. That's your treasure map. That's where you start your search. You might discover a charming town with great schools and a lower cost of living that you never even considered. And every single house there is potentially eligible for a zero down payment loan. But location is only step one. The USDA also has standards for the condition of the home itself. They aren't looking for luxury. They're looking for what they call modest, safe, and sanitary housing. This isn't about granite countertops or stainless steel appliances. This is about the fundamental integrity of the house. The foundation must be sound. The roof can't have active leaks. There must be a working modern electrical system, no old knob and tube wiring. It needs a reliable heating and cooling system. The water must be safe to drink. Essentially, the government is co-signing your loan, and they refuse to back a property that's falling apart or unsafe for you to live in. An appraiser trained specifically in USDA guidelines will walk through the property and check for these things. A handrail missing on a steep staircase? That could be a problem. Peeling paint in a house built before 1978? That's a huge red flag for LEED-based paint and will have to be fixed before closing. This isn't to be difficult. It's a layer of protection for you, ensuring you aren't buying a money pit with a zero-down loan. Now let's switch gears to the VA loan. The Department of Veterans Affairs has a similar philosophy, but they call their standards the Minimum Property Requirements, or MPRs. It's the same core idea. The house must be safe, sound, and sanitary. Think of the VA as the ultimate guardian for our nation's veterans and service members. They will not guarantee a loan on a property that could pose a health or safety risk to the veteran or their family. So what do they look for? The list is specific. The property must have adequate living space, with separate areas for sleeping, cooking, and sanitation. It needs a continuous supply of safe drinking water and a working septic system or public sewer. It needs a heating system capable of keeping the home warm. It needs a roof that will last for the foreseeable future. And this is a big one. It must be free from termites, dry rot, or other wood-destroying pests. A VA appraiser will specifically look for evidence of this. And if they find any, a professional pest inspection and remediation will be required. They'll check for things you might not even think about, like proper drainage to ensure water flows away from the foundation, not towards it. They'll make sure there are no exposed wires or major electrical hazards. The VA standards are, in many cases, even stricter than a standard conventional loan appraisal. A conventional appraiser is mostly concerned with the market value of the home. A VA appraiser is concerned with value and the veteran's safety. They are your advocate in the process. So, how on earth do you find a home that meets all these specific requirements? This is where you have to be smarter than the average buyer. Your first and most powerful tool is a specialized real estate agent. Do not just walk into any real estate office and pick the first agent you see. You need to find an agent who is an expert in either USDA or VA loans, depending on which path you're taking. Ask them directly, how many VA loans have you closed in the last year? Or which neighborhoods in this county are USDA eligible? A great agent will already know the map. They'll know which local home inspectors are tough and what they look for. They can often filter their search on the multiple listing service, the MLS, to only show you homes in USDA-eligible zones. They've seen what passes and what fails an NPR inspection, and they can spot a potential problem from a mile away, saving you hundreds of dollars on an appraisal for a house that was never going to qualify. Your second tool is to learn how to read online listings like a detective. While sites like Zillow or Redfin are getting better, their filters aren't always perfect. Instead, look in the property descriptions for keywords. Agents who know their stuff will often advertise a home as VA ready or qualifies for USDA financing. That's a massive clue. Conversely, if you see phrases like as is, cash only, or handyman special, you should be extremely cautious. These are often code for this house will not pass a government loan inspection. But what happens if you do everything right, find the perfect house, make an offer, and the appraiser comes back with a list of required repairs? Don't panic. This is not the end of the road. This is the start of a negotiation. The appraisal report will list exactly what needs to be fixed. For example, repair the leaky faucet in the main bathroom, or scrape and repaint the peeling paint on the front porch. You then have a few options. Your agent can go back to the seller and negotiate for them to pay for and complete the repairs before closing. This is the most common solution. The seller wants to sell the house, and these repairs will likely be required for the next VA or USDA buyer anyway. Alternatively, you could negotiate a lower price to cover the cost of the repairs, though you'd need to have the cash to do the work yourself immediately after closing. The key is that a repair list isn't a rejection. It's a to-do list. Finding a property that qualifies is a hunt. It requires strategy, the right tools, and the right guide. You have to know the maps, understand the safety standards, and filter out the properties that are non-starters from the very beginning. It's an extra layer of work, but it's what makes it possible to walk into a safe, solid, wonderful home with absolutely no money down. You've now learned how to find an eligible area and an eligible property. You've got the house in your sights. But now the entire process pivots. The spotlight turns away from the property and shines directly on you. The lender is about to put your financial life under a microscope, and the first thing they're going to pull up is that all-important 3-digit number, your credit score. In the next part, we are diving deep into the credit score enigma. What is the real minimum score you actually need for these loans, and how do the lenders really look at it? And I'll reveal the single most common credit mistake that instantly disqualifies almost everyone, and exactly how to fix it before you even think about applying. Alright, let's cut right to the chase. You want to know the magic number, the minimum credit score you need for a zero-down loan. Officially, for a USDA loan, the automated underwriting system loves to see a 640. For a VA loan, the VA itself doesn't set a minimum, but most lenders draw a line in the sand somewhere between 580 and 620. But here's the secret that nobody tells you. That number is almost meaningless. Focusing on that one number is like trying to judge a Super Bowl winning quarterback by only looking at his height. It's a data point, sure, but it tells you almost nothing about his accuracy, his decision-making, or his ability to perform under pressure. Lenders aren't just looking at a 3-digit number. They're reading your financial life story. When you apply, they pull what's called a tri-merge report, combining your data from Equifax, Experian, and TransUnion. And here's the first insider tip. They almost always use your middle score. So if you have a 650, a 680, and a 710, they're not averaging them. They're not taking the highest. They are throwing out the top and bottom and using that 680. But what they really care about, what the human underwriter who makes the final decision is scrutinizing, is the story behind that number. They're looking for stability. They're looking for responsibility. Think about it from their perspective. They're about to hand you a check for hundreds of thousands of dollars, with no down payment as a safety net for them. They need to be absolutely convinced you're a good bet. A person with a 660 score who has paid every single bill on time for 7 years is a much better risk to them than someone with a 720 score who just got a bunch of new credit cards and missed a car payment 6 months ago. The score is the headline, but your payment history is the front page story. And they want to see a boring story. No drama, no late payments, no collections, no charge-offs. Especially in the last 12 to 24 months. That period of your financial life is under a microscope. A 30-day late payment from 4 years ago? They'll probably overlook it. A 30-day late payment from 4 months ago? That's a giant flashing red light. It tells them that you're currently struggling. right at the moment you're trying to take on the biggest debt of your life. So, rule number 1 is to make your recent history squeaky clean. But even if your payment history is spotless, there is one silent killer that torpedoes more zero-down loan applications than anything else. It's a mistake that millions of responsible, hardworking Americans make every single month, thinking they're doing the right thing. It has nothing to do with being late on a bill. It has nothing to do with opening too many accounts. It's a subtle trap hidden in the way our financial system works. The single most common mistake that gets you an instant denied stamp is having a high credit utilization on a single credit card, even if you pay it off in full every month. Let me explain why this is a deal breaker, because it seems completely unfair. Let's say you have a Chase Sapphire card with a $10,000 limit. You're smart. You use it for everything: gas, groceries, your kids' daycare, that new TV, to get those amazing travel rewards. You rack up $8,000 in charges during the month. And then, like clockwork, before the due date, you pay the entire $8,000 balance off. You think you're a financial genius. You've paid zero interest and you just earned a free flight to Hawaii. But here's what the lender sees. Your credit card company usually reports your balance to the credit bureaus on your statement closing date. This is a key detail. It's not the due date, it's the closing date. So, on that one specific day of the month, the credit bureaus get a snapshot. And that snapshot shows that you have a balance of $8,000 on a $10,000 limit. That's an 80% utilization ratio. To a mortgage underwriter's software, that doesn't look like a savvy rewards hacker. It looks like someone who is living on the edge, completely maxed out, and one unexpected car repair away from financial ruin. It screams risk in capital letters. It doesn't matter that you paid it off a week later. The damage is already done. The snapshot has been taken, and that 80% utilization can temporarily crater your credit score. I've seen this personally. A client had a 740 credit score. They were pre-approved. They went out and made a large purchase on one card for a home renovation project they planned to pay off immediately. The statement closed, the balance was reported, and their score dropped to 670 overnight. The lender's system automatically flagged the file, and their pre-approval was nearly pulled. It's that serious. So how do you fix this? It's incredibly simple, and you need to do this at least 1 to 2 months before you even talk to a lender. This is part of preparing your financial profile for its big debut. There are 2 ways. The first and easiest is what I call the prepayment strategy. Find out your statement closing date for every credit card you use. You can call the number on the back of your card and ask, or just look at your last statement. It's printed right on there. Then, set a calendar reminder for yourself 3 to 5 business days before that closing date. On that day, log into your account and make a payment to bring your balance down to under 30% of your credit limit. Ideally, you want to get it under 10%. So in our example with the $10,000 limit, you'd pay off at least $5,000 before the statement even generates. That way, when Chase reports to the bureaus, it reports a balance of $3,000 or less, which is a healthy, responsible-looking utilization ratio. The second method is for people who use their cards heavily throughout the month. This is the micropayment strategy. Instead of waiting, just make multiple payments throughout the month. Every Friday or every time you get paid, log in and pay off whatever you spent that week. This keeps your running balance low at all times. It's a little more work, but it's foolproof. You never risk having a high balance report. Doing this one thing, actively managing your reported balance instead of just your due date, is the single most powerful fast-acting lever you can pull to prepare your credit for a mortgage. It's not uncommon for this one trick to boost a person's score by 30, 50, even 80 points in a single 30-day cycle. It turns that headline number from a liability into an asset. It tells the lender's algorithm and the human underwriter that you are not just responsible, but you are proactive and in complete control of your finances. You go from looking like a risk to looking like a prime candidate. Now, getting your credit score in shape is like getting your car's engine perfectly tuned. It's absolutely crucial. But even with a perfectly tuned engine, you're not going anywhere if you don't have enough gas in the tank. And in the mortgage world, gas is your income. But here's the problem. The way you think about your income and the way a lender is legally allowed to count it are 2 completely different things. They have a secret rulebook for calculating what you actually make, especially if you get bonuses, work overtime, or are self-employed. In the next part, I'm going to break down their hidden income calculations line by line. I'll show you exactly what counts, what doesn't, and a little-known strategy to document unconventional income that could dramatically increase the amount of house you qualify for, without you having to earn a single dollar more. So let's start with the most common scenario. You're a W-2 employee. You get a regular paycheck, taxes are taken out, life is relatively simple. For you, the lender is going to ask for your last 30 days of pay stubs and your last 2 years of W-2s. Now, here's the first critical detail most people miss. The lender doesn't care about your net pay, the amount that hits your bank account. They only care about your gross pay, the big number at the top before taxes, health insurance, and your 401k contributions are taken out. This is good news. It means your qualifying income is higher than you probably think. They'll take that gross monthly income and average it out. If you get paid twice a month, they'll add the 2 stubs. If you get paid every 2 weeks, they'll use a special formula to convert that to a monthly figure. The reason they want 2 years of W-2s is to look for consistency. If your 2023 W-2 shows you earned $80,000, but your 2022 W-2 shows you earned $40,000, they're going to ask why. Did you get a promotion? A new job? They need to be confident that your current, higher income is stable and likely to continue. Overtime and bonuses are a bit trickier. If you're relying on that extra income to qualify, you'll need to show a 2-year history of consistently receiving it. A one-time Christmas bonus from last year won't count. But if you've earned consistent overtime every month for the past 24 months, the lender can average that out and add it to your base pay. This is a huge advantage for nurses, police officers, and tradespeople who often have significant, predictable overtime. Now let's talk about the group that often struggles the most: the self-employed, the freelancers, the 1099 contractors. If that's you, listen very closely, because this is where dreams of homeownership can get crushed by a simple misunderstanding of how banks view your income. You might have brought in $100,000 in revenue last year. You feel successful, but when you go to the bank, they tell you that you only qualify for a tiny loan. Why? Because the bank doesn't look at your revenue. They look at your net income, after all your business expenses, as reported on your tax returns. They will ask for your last 2 years of complete, filed tax returns, all schedules included. They're looking at Schedule C, or your K-1s if you have a partnership or S-corp. They'll find that final number at the bottom, your net profit. Then they'll divide it by 24 to get your average monthly qualifying income. So if you made $60,000 in net profit 2 years ago, and $70,000 last year, your total is $130,000. Divide that by 24 months, and your qualifying income is about $5,400 a month. It doesn't matter if you had a record-breaking month right before you applied, they are almost always going to use that 2-year average. But here is where you can reclaim some of that income. This is the secret for the self-employed. Lenders allow you to add back certain paper loss expenses you claimed on your taxes. The most common one is depreciation. Let's say you're a photographer, and you depreciated $10,000 worth of camera equipment on your taxes. That $10,000 was an expense that lowered your taxable income, but it wasn't actual cash that left your pocket. The lender knows this. So, they will let you add that $10,000 back to your net income before they do the averaging. Other common add-backs include business use of your home, and sometimes mileage. This is why it's absolutely critical to work with a loan officer who understands self-employed tax returns. They can literally find thousands of dollars in qualifying income that another, less experienced officer might miss. Okay, now for the strategy one promised. Documenting unconventional income. This is for the person with a side hustle, the family renting out a spare room, or someone receiving non-taxable benefits. Let's say you rent a room in your current home to a friend for $600 a month. That's real income, but how do you prove it to a lender? You need 2 things: a signed lease agreement, even a simple one, and proof of receipt of funds for the last 12 months. This means copies of canceled checks or bank statements showing the electronic transfer from their account to yours. If you can provide that, many loan programs will allow you to use a portion, usually 75% of that rental income to help you qualify. That's an extra $450 a month in income out of thin air. What about that side hustle money from driving for Uber, selling on Etsy, or freelance writing? If you've been doing it for less than 2 years and just treating it as cash, it's invisible to the lender. To make it count, you have to legitimize it. That means depositing every single dollar into a dedicated bank account and, most importantly, reporting it on your taxes. Once you have a 2-year history of reporting that income on a Schedule C, it becomes just as valid as any other self-employment income, and you can use it to qualify. But here is the most powerful and least known strategy of all. It's called grossing up non-taxable income. Certain types of income, like Social Security disability benefits, some pension payments, and child support, are not taxed. Remember how we said lenders only look at a W-2 employee's gross income before taxes? Well, they want to put you on an even playing field. If you receive $2,000 a month in non-taxable disability benefits, the lender knows that's equivalent to someone who has to earn much more, say $2,500, before taxes are taken out. So they allow you to gross up your non-taxable income by a certain percentage, typically 15 to 25%, depending on the loan program. Let's do the math. You get $2,000 a month in child support. The lender applies a 25% gross up. They take $2,000, multiply it by 1.25, and suddenly your qualifying income from that source isn't $2,000 anymore. It's $2,500. That's an extra $500 a month in buying power. Over the life of a loan, that could be the difference that gets you into the neighborhood you really want. To use this, you'll need to provide the award letter or court decree stating the amount, and proof that you've been receiving it for the last 6 months, and that it's expected to continue for at least 3 more years. So now that we understand what money counts, how does the lender use it? They use it to calculate the single most important number in mortgage lending, your debt-to-income ratio, or DTI. It's simple. DTI is the percentage of your gross monthly income that goes towards paying your monthly debt obligations. There are 2 DTI numbers. The first is the front-end ratio. This is just your proposed new housing payment, principal, interest, taxes, and insurance, divided by your gross monthly income. So if your new all-in mortgage payment is $2,000, and your qualifying income is $6,000, your front-end ratio is 33%. But the one that really matters, the one that makes or breaks your approval, is the back-end ratio. This includes your new mortgage payment plus all your other monthly debts on your credit report. We're talking car payments, student loans, credit card minimum payments, and personal loans. So let's take that same scenario, your $6,000 monthly income and your $2,000 mortgage. Now let's add a $400 car payment and a $100 minimum credit card payment. Your total monthly debt is now $2,500. You divide that by your $6,000 income, and your back-end DTI is about 41.6%. Every loan program has a maximum DTI limit. For many zero-down programs, this limit can be surprisingly flexible, sometimes going as high as 45, 50, or even 55% in some cases. But the lower your DTI, the stronger your application, and the more confident the lender will be in your ability to repay the loan. Understanding your income isn't just about finding every last dollar. It's about knowing exactly how it stacks up against your debts in this crucial calculation. And that brings us to the other side of the equation. We've mastered income. But what about debt? You might think you know what you owe, but I guarantee the lender sees things you don't. There are phantom debts that can appear on your credit report and sabotage your DTI at the final hour. And there are specific ways to strategically pay down or restructure your debt before you apply that can have a massive impact on your borrowing power, far more than you'd expect. We're going to break down your credit report from an underwriter's perspective, and I'll show you which debts to tackle first to get the biggest bang for your buck and instantly improve your DTI score. So let's dive right in. When you think of your credit report, you probably think of a single 3-digit number. A 720, a 680, a 590, and you think, okay, that's my grade. That's what the bank sees. But that's not what an underwriter sees. An underwriter doesn't see a grade. They see a story. They see a detailed history of every promise you've ever made to pay someone back, and whether you kept that promise. That number is just the book cover. They are about to read every single page, and their job is to calculate risk. Your debt-to-income ratio is their primary tool for this. It's a simple formula on the surface. Your total monthly debt payments divided by your gross monthly income. But the magic, and the part where most people get tripped up, is in how they calculate those total monthly debt payments. It's not always what you think it is, and understanding this difference is the key to unlocking tens of thousands, or even hundreds of thousands of dollars in borrowing power. Let's break down your credit report into the 3 main sections an underwriter scrutinizes for your DTI calculation. First, you have your payment history. This is binary. It's pass/fail. A single 30-day late payment in the last 12 months can be a deal killer for many loan programs. It tells the underwriter that you're struggling to manage your current obligations. So why would they trust you with a massive new one? Before you even think about DTI, Your payment history for the last 24 months needs to be spotless. No exceptions. Second, and this is where we find our first massive lever, is revolving debt. These are your credit cards, your store cards, your lines of credit. Underwriters look at this section with extreme prejudice for two reasons: utilization and payment calculation. Utilization is the percentage of your available credit that you're using. If you have a $10,000 credit limit and a $9,000 balance, you are 90% utilized. To an underwriter, this screams financial distress. It tells them you're living on the edge, with no buffer for emergencies. High utilization will crush your credit score. But here's the hidden DTI bomb. Let's say your minimum payment on that $9,000 balance is only $180. You might think, great, the bank will only count $180 against my DTI. Wrong. Many lenders, especially for government-backed loans, have a rule. They will count either your minimum payment or 5% of the outstanding balance, whichever is greater. 5% of $9,000 is $450. Suddenly, that one credit card isn't a $180 debt in their eyes. It's a $450 monthly obligation. It more than doubled its impact on your DTI just like that. This is a silent killer of mortgage applications. The third section is installment loans. These are your car loans, student loans, and personal loans. They have a set payment for a set period. They're predictable, which underwriters like. For a car loan or a personal loan, it's simple. They take the monthly payment you see on your statement and add it to the DTI calculation. But student loans? Oh, student loans are the final boss of DTI calculations. This is, without a doubt, one of the biggest and most painful surprises for first-time homebuyers. Let's say you have $100,000 in student loans, but they're in deferment or forbearance, and your required payment is zero. Or maybe you're on an income-based repayment plan or IBR, and your calculated payment is zero. You think, fantastic, that's a $0 debt for my DTI. I am sorry to tell you, the lender almost never sees it that way. For an FHA loan, for example, the lender is required to ignore your $0 payment. Instead, they must calculate a hypothetical payment, which is typically 0.5% of the total loan balance. So on your $100,000 in student loans, they will add a $500 monthly payment to your DTI calculation, even if you aren't paying a single dime. Some conventional loan programs are even tougher, using a full 1%, which would be a $1,000 monthly payment in this example. This single rule has disqualified millions of otherwise perfectly qualified buyers. So now we see the battlefield. We have high-impact revolving debt, straightforward installment loans, and wildly unpredictable student loans. You have a limited amount of cash to pay things down before you apply. Where do you put it for the biggest bang for your buck? The answer is almost never what you think it is. Here is the underwriter's playbook in reverse. This is your strategic priority list. Priority number 1 always is high utilization revolving debt. That credit card with the $9,000 balance? Attacking that is your primary mission. Let's say you have $3,000 to work with. If you pay that card down from $9,000 to $6,000, two incredible things happen. First, your utilization drops from a terrifying 90% to a much healthier 60%. Your credit score will jump, maybe by 20 or 30 points. Second, the lender's DTI calculation changes. Instead of using 5% of $9,000, which was $450, they now use 5% of $6,000, which is $300. You just freed up $150 in monthly DTI with one payment. That $150 in breathing room could equate to roughly $25,000 more in home you can afford. Priority number 2 is small balance installment loans that are nearing their end. Do you have a personal loan with a $250 payment that only has $1,000 left on it? Pay it off completely. That $250 monthly payment is now gone from your DTI calculation. It's a clean kill. It's often far more effective to wipe out a small loan entirely than to chip away at a much larger one. And this brings us to a powerful secret weapon: the 10-month rule. Many lenders have a guideline that allows them to completely disregard an installment loan payment if there are 10 or fewer payments remaining. So, let's say you have a car payment of $400 a month with 12 months left. If you make 2 extra principal payments, bringing the remaining term down to 10 months, your loan officer might be able to completely exclude that $400 payment from your DTI. This is a conversation you must have with your lender, as rules can vary, but it is an incredibly powerful strategy. Paying just $800 could free up $400 per month in borrowing power. The return on investment is astronomical. Your last priority in most cases is the giant debt, the big car loan with 4 years left, or the massive student loan balance. Putting a few $1,000s against a $100,000 student loan is like throwing a bucket of water into the ocean. It won't move the needle on the 0.5% or 1% payment calculation the lender is forced to use. The strategy for student loans isn't about paying them down. It's about documentation. If you are on an IBR plan, you need to see if you can qualify for a conventional loan program that will accept your actual IBR payment, as long as it's reporting on the credit report and is greater than 0. This might mean switching your loan strategy from FHA to conventional, but it could save your application. Let's put this into a real-world example. Meet Alex. Alex makes $75,000 a year, which is $6,250 a month. He has $5,000 saved up to clean up his debt before applying for a zero-down USDA loan. Here's his debt profile. A Visa with a $7,000 balance on a $7,500 limit. 93% utilization. The minimum payment is $140, but the lender will use the 5% rule, hitting him for $350 in DTI. A car loan with a $450 payment. He has 11 months left. And $80,000 in deferred student loans. The lender will use the 0.5% rule, hitting him for $400 in DTI. His total monthly debt, in the underwriter's eyes, is $350 plus $450 plus $400, which equals $1,200. His DTI is $1,200 divided by $6,250, which is 19%. That's great, but he wants to maximize his borrowing power. What does he do with his $5,000? The amateur move is to throw it all at the high-interest credit card. Not a bad idea, but not the best. His balance would go to $2,000. His new DTI payment on the card would be 5% of $2,000, which is $100. His total DTI debt would drop from $1,200 to $950. A good improvement. But Alex knows the underwriter's playbook. First, he takes $450 and makes one extra payment on his car loan. Now it has 10 months remaining. He confirms with his lender that they can now completely exclude this debt. Boom! The $450 payment vanishes from the calculation. He takes the remaining $4,550 and pays down the credit card. The balance drops from $7,000 to $2,450. His utilization plummets from 93% to 32%. His credit score soars. And the lender's calculated payment? 5% of $2,450 is now just $123 a month. Let's look at the new numbers. The $450 car payment is gone. The $350 credit card payment is now $123. The $400 student loan payment remains. His new total monthly debt is $523. He went from $1,200 in monthly debt to $523. He cut his DTI in half, from 19% down to just over 8%. He just gave himself back nearly $700 a month in borrowing capacity. On a 30-year mortgage, that translates to over $115,000 in additional home price he can now afford. All by strategically using the exact same $5,000. This is how you beat the system. You don't just pay your debt. You dismantle it in the order that matters most to the person approving your loan. Now that you've optimized your credit and weaponized your DTI, you look like the perfect borrower on paper. But there's one final hurdle that stops so many people, even with a zero-down loan: cash to close. Yes, even with no down payment, you still need money in the bank. But how much? Where can it come from? Can it be a gift? What are reserves? Up next, we're demystifying every dollar you'll need to bring to the closing table, so you're not hit with a devastating financial surprise just days before getting your keys. So let's pull back the curtain on the single biggest shock for first-time homebuyers: closing costs. The term zero down payment is brilliant marketing, but it's dangerously misleading. It makes you think you can walk into a bank, sign some papers, and get the keys to a house with nothing but the lint in your pocket. That is a fantasy. Zero down payment means you aren't borrowing money for the down payment. It does not mean zero cash to close. The cash you need to close is a separate, significant pile of money, and it's made up of 3 distinct categories: lender fees, third-party fees, and the big one most people forget: prepaids. Let's tackle them one by one. First, lender fees. This is what you pay the bank for the service of creating your loan. The biggest one is often the origination fee. Think of it as the lender's commission. It's typically a percentage of the loan amount, maybe 0.5% to 1%. So on a $300,000 loan, that's $1,500 to $3,000 right there. You might also see smaller fees like an underwriting fee or a processing fee. These cover the salaries of the people who are meticulously combing through your financial life to make sure you're a good risk. All told, the lender's direct fees are usually the smallest portion of your total closing costs, but they're non-negotiable. Next up, the second bucket, third-party fees. This is where the list gets long. These are costs for essential services provided by people other than your lender, but that your lender requires to close the loan. The first one you'll encounter is the appraisal fee. The bank needs a licensed appraiser to go out to the property and confirm it's actually worth the price you're paying. They won't lend you $300,000 for a house that's only worth $250,000. That's a $500 to $700 fee you pay. Then you have the title company fees. This is huge. The title company does two critical things. First, they perform a title search. They dig through decades of public records to make sure the person selling you the house actually has the legal right to sell it, and that there are no old, hidden claims or liens on the property from previous owners, their angry ex-spouses, or unpaid contractors. This protects you from buying a legal nightmare. Second, they issue title insurance. You'll actually buy two policies. The first is a lender's title insurance policy, which is mandatory. It protects the bank's investment in your property. The second is an owner's title insurance policy, which protects you. If some long-lost heir shows up 5 years from now claiming the house is theirs, your owner's policy is what pays for the legal battle to defend your ownership. Do not skip the owner's policy. It's a one-time fee at closing, and it protects you for as long as you own the home. Together, these title services can easily cost $1,000 to $2,000 or more, depending on your state and the home's price. But the third-party fees don't stop there. You'll see smaller charges for a credit report, a flood certification to see if the home is in a flood zone, and maybe some recording fees that you pay to the county to officially document you as the new owner. It feels like you're being nickeled and dimed, but each fee corresponds to a real service that's required to make the transaction legal and secure. Now for the third and often largest bucket, prepaids and escrows. This is the one that confuses everyone. These aren't fees. This is your money that you're prepaying for expenses you will have as a homeowner. The two big ones are property taxes and homeowner's insurance. Let's start with homeowner's insurance. Your lender will not give you a penny until you prove you have a homeowner's insurance policy in place that covers the home from the day you close. And they don't just want to see a policy. They require you to pay the entire first year's premium upfront at closing. If that premium is, say, $1,800 for the year, you have to bring that $1,800 to the closing table. Then there's property taxes. This gets a little more complicated. Your local government charges property taxes to pay for schools, roads, and fire departments. The lender is terrified you'll forget to pay them, because if you don't, the government can put a lien on your house that takes priority over the mortgage, meaning the government gets paid before the bank does if you foreclose. The bank hates that. So, to protect themselves, they set up an escrow account. Think of it as a forced savings account for your taxes and insurance. Every month, your mortgage payment won't just be principal and interest. It will be principal, interest, taxes, and insurance. The T and I portions go into your escrow account. Then, when the tax bill and insurance premium are due each year, the lender pays them for you from that account. To get this account started, they need to collect a cushion at closing. They'll typically collect several months' worth of property taxes and a couple of months' worth of homeowners' insurance premiums. If your property taxes are $6,000 a year or $500 a month, they might collect 3 to 4 months' worth at closing. That's another $2,000. So, when you add it all up, lender fees, third-party fees, and your prepaid insurance and tax escrow, how much are we talking about? A good rule of thumb is that closing costs typically run between 2 to 5% of the purchase price. On a $300,000 home, that's $6,000 to $15,000. That's a huge number to face when you thought you were getting a zero-down loan. But wait, there's more. On top of closing costs, some lenders, especially for certain loan types, will also require you to have cash reserves. This is money you have to have left over in your bank account after you've paid all your closing costs. It's your emergency fund. The lender wants to see that you won't be completely broke on day one. If a water heater explodes a week after you move in, they want to know you can afford to fix it without missing your first mortgage payment. They'll usually want to see 2 to 6 months worth of your full pity payment sitting in your account. So if your total mortgage payment is $2,500 a month, you might need an extra $5,000 to $15,000 just sitting in savings. Now I know what you're thinking. This sounds impossible. How can anyone possibly come up with this kind of cash for a zero-down loan? This is where the strategy comes in. You have 4 primary ways to cover these costs. First, your own savings. Simple, clean, but not an option for everyone. Second, gift funds. Most loan programs, including VA and USDA, allow you to receive a gift from a close family member to cover your closing costs and reserves. It can't be a loan. It has to be a true gift with no expectation of repayment. Your donor will have to sign a gift letter stating this, and you'll have to show the money moving from their account to yours. Third, and this is the most powerful tool, is negotiating for seller concessions, also called seller credits. This is where you ask the seller to contribute a certain amount of money toward your closing costs. You might offer the full list price for a house, but ask for a 3% seller concession. On a $300,000 home, that's $9,000 the seller gives you at closing to cover your costs. Why would a seller do this? Because it helps them sell their house. It's often easier for a seller to give you a credit than to just lower the price by $9,000, because that credit helps you, the cash-strapped buyer, get the deal done. Each loan program has limits on how much the seller can contribute. VA and USDA are quite generous here. Fourth, you can ask your lender for a lender credit. This is where the lender agrees to pay some or all of your closing costs for you. But there is no free lunch. In exchange for this credit, they will give you a slightly higher interest rate for the life of the loan. You're essentially financing your closing costs over 30 years. It can be a great option if you're short on cash, but you'll pay more in the long run. 3 days before your scheduled closing, you will receive the most important document you've seen yet: the closing disclosure. This 5-page form itemizes every single dollar, every fee, every credit, and tells you the final, exact amount of cash you need to bring to close. Your job is to compare this document to the initial loan estimate you received and question every single discrepancy. You've now stared into the financial abyss of closing costs and reserves, but you've also been armed with the strategies to conquer them. You know what they are, how much they might be, and where the money can come from. You're prepared. But getting the money together and signing the papers is only the penultimate step. The dream can still turn into a nightmare if you make one of several common mistakes in the final days before closing, or even in the first few months of homeownership. The finish line is in sight, but the last leg of the race is filled with traps. What are they? And how do you avoid them to truly secure your new home for the long haul? That's what we're covering in our final part. You've navigated the labyrinth of loan applications, survived the underwriting gauntlet, and signed a mountain of paperwork at closing. The keys are in your hand. This is the moment you've dreamed of. But this is also where the most critical phase begins, and where so many new homeowners, especially those starting with zero equity, stumble. The first major trap is becoming house rich and cash poor. It's a silent crisis. You technically own an asset worth hundreds of thousands of dollars, but your bank account is running on fumes. You have the fancy car but no money for gas. Every dollar of your paycheck is pre-allocated to the mortgage, utilities, and basic living expenses. There is zero buffer. A single unexpected event, a medical bill, a car repair, a temporary job loss, doesn't just become an inconvenience. It becomes a potential catastrophe that could lead to foreclosure. The antidote to this is not glamorous, but it is essential. You must become a savings zealot. The emergency fund we talked about building before you bought the house? That was just boot camp. Now the real war begins. Your new mission, starting from day one, is to rebuild and fortify that cash reserve. Automate your savings. Every single paycheck, a set amount must go directly into a high-yield savings account, untouched. Treat this savings deposit with the same non-negotiable importance as your mortgage payment. Your goal should be to get back to having at least 3, and ideally 6 months' worth of essential living expenses saved up. This isn't extra money. This is your home's life support system. It's the fund that lets you sleep at night, knowing that if the air conditioner dies in the middle of a July heat wave, you can fix it without having to choose between comfort and your next mortgage payment. Being house rich and cash poor is a prison with a nice facade. Financial freedom is having the cash to truly enjoy and protect the house you worked so hard to get. The second and perhaps most common trap is a massive underestimation of the true cost of ownership. Your lender approved you based on pity, principal, interest, taxes, and insurance. But the house doesn't care about pity. The house has its own list of demands. Your monthly budget needs to account for what I call the ghost bills. The expenses that don't show up in your mortgage statement, but will absolutely show up in your life. Utilities are a big one. You're likely moving from a smaller apartment to a larger house. That means higher bills for electricity, gas, water, and trash. Then there's internet and cable. If you're in a neighborhood with a homeowners association or HOA, that's another fixed monthly or quarterly fee you cannot miss. But the real budget buster is maintenance and repairs. Things will break. It is not a question of if but when. The lawn needs to be mowed, the gutters need to be cleaned, the furnace filter needs to be replaced. Those are the small recurring costs. The big ones are the lurking predators, the $10,000 roof replacement, the $5,000 HVAC system failure, the $3,000 water heater that floods your basement. These are the expenses that sink homeowners who are living on the edge. A fantastic rule of thumb is the 1% rule. You should aim to save, at a minimum, 1% of your home's purchase price every single year, dedicated exclusively to maintenance and repairs. If you bought a $350,000 house, that's $3,500 a year, or about $290 a month. This isn't your primary emergency fund. This is a separate, dedicated home repair sinking fund. When you have this fund in place, a broken appliance is an annoyance you pay for with cash, not a financial crisis that sends you into high-interest credit card debt. The third trap is what I call PMI paralysis. If you used a conventional loan with zero down, you're paying private mortgage insurance. If you used an FHA loan, you're paying a mortgage insurance premium. USDA and VA have their own guarantee fees. It's easy to see this extra $100, $200, or $300 a month as just a permanent part of your payment. That is a costly mistake. This insurance doesn't protect you. It protects the lender. Your goal should be to eliminate it as soon as humanly possible. For conventional loans, the magic number is 20% equity. Once your loan-to-value ratio hits 80%, meaning you owe 80% of the home's original value, you can formally request that your lender remove PMI. By law, they are required to automatically terminate it when you reach 78%. So how do you get there faster? 2 ways. Paying down your principal and home appreciation. Every mortgage payment you make chips away at the principal, but you can accelerate this. Even an extra $50 or $100 per month, applied directly to the principal, can shave years off your loan and get you to that 20% equity mark much faster. The other factor is a rising market. If you bought your home for $300,000 and 2 years later, comparable homes in your neighborhood are selling for $375,000, you have built significant equity through appreciation. You can pay for a new appraisal, and if it confirms the new higher value, you can present that to your lender to show you've crossed the 20% equity threshold and demand they remove PMI. Getting rid of that payment is like giving yourself an instant raise every single month. This leads us to the fourth trap, the siren song of refinancing. You'll get mail, emails, and ads constantly. Lower your rate. Lower your payment. Refinancing can be a brilliant financial move, but it can also be a trap that resets your progress. The key is to look past the shiny new interest rate and analyze the closing costs. Refinancing isn't free. You'll typically pay 2% to 5% of the new loan amount in fees. A no-cost refinance simply means the lender is rolling those thousands of dollars of fees into your new loan balance, or giving you a slightly higher interest rate to cover them. You're still paying. You have to do the math. Calculate your break-even point. If refinancing costs you $5,000 in fees but saves you $200 a month, it will take you 25 months just to break even. If you plan on moving before then, you've actually lost money. Also, be careful about the term. Refinancing your 30-year mortgage back into a new 30-year mortgage, 5 years after you bought the house, means you're resetting the clock. You'll have a lower payment, but you'll be paying for a total of 35 years. Sometimes it's smarter to refinance into a shorter term, like a 15-year loan, if you can afford the higher payment. Your interest rate will be even lower, and you'll build equity at lightning speed. Finally, the fifth and most profound trap is forgetting the ultimate goal. A zero-down mortgage is not the prize. The house is not the prize. The prize is financial security and wealth creation, and the house is simply the vehicle to get you there. You must avoid short-term thinking and embrace the long-term equity game. Every single mortgage payment you make is a form of forced savings. Part of it goes to interest, yes, but a growing portion of it goes to principal, reducing what you owe and increasing what you own. That portion, your equity, is a deposit into your own net worth. It's an investment in your financial future. As you pay down your loan and as the property, hopefully, appreciates in value over decades, your equity grows into a powerful financial asset. This is the wealth that can help you send a child to college, start a business, or fund a comfortable retirement. It's the fundamental difference between renting, where your monthly payment builds your landlord's wealth, and owning, where it builds your own. A zero-down payment mortgage is one of the most powerful financial tools available. It can pry open the door to homeownership for people who would otherwise be locked out for years. But it is not a shortcut. It is an opportunity that comes with immense responsibility. It demands more discipline, more planning, and more financial vigilance than a traditional mortgage. You've now walked through the entire process, from understanding the programs to avoiding the post-purchase traps. You have the knowledge. The path from renter to successful, wealth-building homeowner is not easy, but it is clear. Build your budget, fortify your savings, attack your loan principal, and always play the long game. You have the blueprint. Now go build your future.